Hi, my name is Brant Spessart with Steward Wealth Strategies, and I just want to say thank you for tuning in and investing some time with us. Today, we're going to talk about managing your wealth in 2024. So, an educated client is our best client because we all know the phrase knowledge is power. And if you think about it, what we try to help our clients with is stewardship. Stewardship is where we're managing resources that have been entrusted to us, and we want to make wise decisions. We want to do what's in the best interest of our client. Our clients want to do what's in the best interest of their financial objectives and goals. And that's one reason why we host these webinars, so that we can help educate our clients so that they can make great decisions. And we hope that you find this information valuable. And if you ever have questions or concerns, please reach out to your wealth manager here at Steward Wealth Strategies. Now, when it comes to financial planning, we have to remember that it's not just investments, it's not just retirement, but financial planning has really six key areas that we like to help our clients focus on. One is protection planning. Am I doing what I need to do to make sure my family is protected, or I'm protected, or my assets are protected in case something happens? Also, retirement planning. We know our clients have goals and dreams that they want to, pursue and stuff. And, there's a lot of big decisions that come with the retirement decision. Tax planning. Not too many people want to really send more money to Washington, D.C. than they need to. And tax planning is a very important part of financial planning. And then estate planning, the one area that's inevitable for all of us. And then investment planning. And then here at Steward Wealth Strategies, we really feel like God has blessed us so we can be a blessing. We really love helping our clients with generosity strategies. So 2023 ended up being a good year, but it had a really strong end to the year. In fact, if you think about it, at the beginning of last year, most folks after 2022, the tough year we had in 2022, most analysts and economists were saying 2023 was going to be a really bad year. But stocks defied the odds. We hit some highs. There was a great rally in fourth quarter. And if you look at the year in its entirety, there was a ton of volatility. I mean, look at the end of first quarter last year and look at, how fourth quarter started off. But from start to finish for 2023, the S&P 500 had a fantastic year. And a lot of the ups and downs that we experienced had to do with interest rates. And the rally we saw at the end of the year was really where the Fed was talking about possible interest rate cuts. And if we think about the equity market as a whole, 2023 ended on a positive note. Now, volatility was there last year. We felt a lot of volatility last year. So patient investors that focused on the long term were the ones that were rewarded. If you got in and out, you could have gotten really hurt last year. But if you were patient and endured the volatility, you were rewarded. Inflation has slowed, and it's moving closer. It's not quite there yet, but it's moving closer to the Fed's goal of 2%. And the Fed has said that there may be interest rate cuts in 2024. And we've heard the phrase soft landing. We experience, they're anticipating what's called a soft landing versus a major recession. So inflation is really the measurement of the cost of goods and services going up. So when we talk about inflation slowing, that doesn't mean cost of goods and services are actually going down. It's just not going up at the same pace that we saw right after the pandemic. I mean, if you look at that in 2022, we saw inflation up around 9%, and we all felt it. But at the end of last year, general inflation was about 3.5% to 4%, much better. And how does that impact us? I mean, think about everyday expenses. Food. Food is back at a normal inflationary rate, but I know a lot of us were getting sticker shock, or still are getting sticker shock every time we go to a restaurant or the grocery store. But then we've got our utilities have gone up. Shelter home prices, especially like if you're in the North Carolina area, home prices are still going up. Cars, it's interesting now you can drive by car lots and see a lot of vehicles on the lots. So prices have slowed down there some, but transportation services continue to go up at a pretty high clip. But here's the one thing we have to keep in mind. When the Fed talks about interest rate changes, so we understand that that's made a difference as far as the economy is concerned. Hey, it's helped the stock market, with those headlines and stuff. But how does that affect parts of a portfolio? If you have conservative parts of your portfolio, such as bonds, just know when interest rates went up significantly, like they did in 2022, bond prices took a huge hit. That's why in 2022, aggressive investors in equities and even conservative investors felt pain. But here's the thing. If interest rates do go down and the Fed does cut rates, that could help elevate existing bond prices. And right now, when we're looking at treasury yields, just kind of recap where we ended 2023. The 5-year was at 3.84%, the 10-year was at 3.88, the 20-year was at 4.2, and the 30-year was just a little over 4.0. But if we think about that, how does that affect most of us when it comes to our banking? Well, the national average, now this is national average for bank money markets, is still less than 1%. 12-month CDs, a little closer to 2%. These rates aren't terribly exciting, but when you compare them to a year ago, they are significantly better. Now, I know a lot of us, clients as well as team members here, we use maybe high yield money market accounts or savings accounts, or maybe we're, using CDs that are paying a lot higher than average rates. If you are looking for a higher yield money market or a higher yield CD, especially CDs, reach out to us if we can help you out, or talk to your bank or your credit union to see if there's better options out there. There are a lot of really good cash rates right now, but sometimes you have to ask or do a little searching. Let us know here at Steward Wealth if we can help you out with that. But what do we think about the stock market, or what do we think about the investment markets when it comes to 2024? Well, you hear us say this a lot: proceed with caution. Now, normally we have a big yellow sign. In fact, my middle son just got his driver's license earlier this week, so we were reviewing the signs. But we really do think you should proceed with caution, because what do we know is going on in 2024? Well, prices of goods and services. Inflation may not necessarily be a big concern right now, but we do know that prices are higher now than where they were 5 years ago. And some areas of our life, prices are still going up significantly. So we still have to think about inflation. And we do have to think about, interest rate percentages. Is the Fed going to change rates? Are they going to cut rates? Are you a borrower? Are you a saver? And then what about the global economy and global unrest? We're still seeing a lot of headlines coming from the Middle East and a lot of headlines coming from Europe right now, as well as Asia. But then what's going on in the US that's going to be big this year? Well, it's an election year. But here's the one positive headline we have seen, or we've heard of: soft landing. Now, this isn't a phrase that gets people's attention. Remember, a lot of times in the world of media, they're trying to get your attention. So, and fear is the most dominant human emotion. So when you see headlines, usually there's some sort of shock or concern, something that's going to get you to read or listen or click. But what they're talking about right now is, for the economy, a soft landing. And a soft landing is different than a recession. It's different than stagflation. Soft landing is basically saying, hey, look, we think we're going to have low inflation and low unemployment. But there's still some concerns about interest rates. Well, what are we looking at right now? So the Fed last year actually raised rates, but did it at a much slower pace or easier pace than what it did the prior year. The prior year, we saw the greatest rate increases that we'd seen in decades. Last year, rates still went up some, But instead of moving up at really big clips, they were a lot steadier. And then what happened in the second half of last year? They held steady a few times when the Fed met. And in fact, at some of those meetings, they were talking about cutting rates for this year. So we have a few meetings this year that the Fed has a few meetings this year where they're going to discuss and make decisions on interest rates. They've met once already in January, and they decided to keep rates steady. We'll find out this spring a couple times if they're going to keep rates steady or if they're going to start cutting the interest rates at that point. Now, if we think about this term, soft landing, how's the stock market done when there's been a soft landing? A lot of folks had concerns that, hey, look, if we went into a recession, the stock market's going to have a lot of volatility, going to have losses. People start thinking about bread lines, high unemployment, and so forth. But now we've heard the phrase soft landing. So this is a look at the S&P average rate of return for cycles since 1965. And what it's looking at is, hey, when you've had the Fed cut rates, is comparing the S&P returns after the first cut is to the right of that dotted line. If there's a soft landing versus the average versus if we're in a recession. So soft landing historically has had some really good results as far as equity markets are concerned. Now, this doesn't predict the future. Past performance does not predict future results, but it does give us hope. And we want to be good stewards of our client relationships. We want to help you make decisions that are in your best interest, and making informed financial decisions can lead to better outcomes. Is it better to react with your finances emotionally or knee-jerk reactions? Or is it better to react with calculated decisions or knowledge or fact or data? So here's the thing for 2024. We have hopes that it really will be a soft landing. But one thing we do know, whether it's a soft landing or a recession or just a normal market, equities, and equities are stocks, even if we're using mutual funds, ETFs, or index funds that are invested in the stock market, equities are a long-term commitment. Here at Steward Wealth, we do not gamble with clients' money. We don't believe in short-term trading. If you have equities in your portfolio, we're focused on the long term. But we also think it's better to be proactive than reactive. Right now I'm recording this during tax season. Would you rather be proactive with your taxes or reactive with your taxes? Proactive planning is key to a solid financial strategy. And remember, there's 6 key areas of financial planning: estate planning, tax planning, protection, investment, retirement, and generosity. Be proactive, have a plan, have a strategy. But just remember, when it comes to investments, volatility remains. And guess what? Volatility is always there. Because if an investment's not volatile, then it's probably savings. The reward for dealing with volatility is long-term growth. A long-term strategy needs to be the benchmark for smart investors, not how did the market do last quarter or last week or last month. We know it's going to go up and down, but we also know if you've been in good quality investments or even average investments over the long term, even with volatility, it has grown. So inflation is likely to settle. With interest rates, we could have some stagnation or reduction, but borrowing is still costly. Now, I know for a lot of you that may have been borrowers or had mortgages back in the 80s, you're like, hey, these interest rates are still extremely low. But recency bias, if we look at just over the past decade, these rates are quite a bit higher than they were just a couple of years ago. But have a well-devised financial plan, but have a financial plan that is based on you and your goals and your situation. So our role here at Steward Wealth is to help guide you and work with you and shepherd you along the way while you work through your financial plan and you make big financial decisions and you enter different stages of life. We want you to focus on your goals and objectives. Let us focus on the plan. But just remember, we always want to proceed with caution, but we are here for you. So if you ever have questions or concerns, reach out to your wealth manager here at Steward Wealth. So I want to end just like I started and say thank you. Having an attitude of gratitude is critical, because we know if there weren't clients like you, we would not be able to be in business, and we wouldn't be able to, pursue the passions and the careers that we love here at Steward Wealth. We love helping our clients. So it is an honor to serve you. I hope 2024 is having a good start so far, and I hope it ends up being a great year for all of you. If there's anything we can do for you, whether it's financial planner wise or pray for you, please reach out to us. Let us know. Thank you so much, and God bless you.